Good afternoon, everybody. My name is Bjorn Tremmerie. I'm responsible for tech investments at European Investment Fund. And in the next 15 minutes or so, I'm going to give you insights into how we see the venture market in Europe and how the returns have been, especially in the current times where we all know that the pandemic and the COVID-19 pandemic is ravaging around the world. I'm going to try to present from my side by sharing my screen, and hopefully then you can also follow the presentation that I've prepared for this. So I hope that you can see the presentation. Potentially you can also see me. So for those not familiar with the EIF, we're the largest investor in venture capital in Europe. We typically invest 1.6 billion per year. That's roughly half of what we invest on an annual basis across private equity in an annual basis. So with that, we're by far the largest investor in European venture. We've been doing that for over 20 years. And yeah, that gives us a good opportunity to know what's going on in the market. And we're more than willing to share that with you. For those familiar with my presentations, we have for the last couple of years been demonstrating that Europe has now a well-functioning venture capital ecosystem, which is based on the fact that we can attract new talent, that we create successful entrepreneurs, even serial entrepreneurs. Take a look at what Daniel Ek is now doing as well, putting 1 billion of his wealth to support European venture capital. So those are excellent things to support further the ecosystem in Europe. We have always had disruptive innovation and good innovation. We've got fantastic events like the one that we're at today, the Arctic15, that helps as a pillar for spreading the news about European tech and venture as well. And nowadays, anybody with a good idea can get funded. What's also important is that our founders have become increasingly ambitious. They don't want to sell too early, but also our VC funds have become ambitious. When I started in this industry, people were taking my money with the aim of managing it, not to lose it. Now people want to take the money and invest it with the aim of maximizing returns. And if you have better ambition levels, then you also have better exits, which in turn then create new role models to attract new talent. And so the wheel spins on faster and faster. How can we show this maturity of the ecosystem? I've in past presentations also referred to the role of the mafia. Each good ecosystem like Silicon Valley has their own mafia. Here a reference to the PayPal mafia. People created PayPal, then set out to create even bigger companies. And last year I was lucky enough to read a Forbes article where they referred to the Skype mafia. So Europe has now its own mafia as well. And that is important. I could refer to the Skype mafia, but in the meantime, we probably have a Spotify mafia, a Criteo mafia in France, an Adyen mafia in the Netherlands, or a Rocket or Zalando mafia in Germany. So this concept of success breeding success is very important. But no mature ecosystem without returns. And some people may have heard about the Ryder Cup slides that we have put up at some presentations as well, where we compare the top quartile cutoff points in the US and Europe. And historically, we were always beaten by the US. But since the global financial crisis, actually, it's been more it has been more more competitive. But then the pandemic came, and I think let's use it as an opportunity. To quote Winston Churchill, never let a good crisis go to waste. Let's not waste this crisis. I would like to use this pandemic crisis to see whether we're making it as an ecosystem, whether we can resist a crisis. Because in the past, European venture capital ecosystem was not stress resistant or crisis resistant. After the dot-com crisis, we had a nuclear winter. And also in the aftermath of the global financial crisis, we were suffering a bit. Let's see what it's looking like now. At the end of Q1, this is our venture capital index. The blue line shows our index. So since 2010 rebased compared to the Morgan Stanley MSCI index, and our buyout portfolio with with the yellowish line. And at the end of Q1, we got a bit shocked because we were going in a lockdown in Europe and globally. And that, of course, had an impact on not only global markets, but also on our portfolio. And yeah, our index dropped by 3%, and we were not sure what was going to go, what direction it was going to go further, where it was going to go down or up, be a dramatic crash or not. But then as the lockdown continued, we started observing that public markets actually rebounded quite well, and mostly driven by tech. If you look here at the index of the Nasdaq Index, it's by far flourishing, and it's up 30% year to date. And it's outperforming the Standard & Poor's and the Dow Jones. So tech plays an important role here in the rebounding of bouncing of the markets, and that's not a surprise because actually technology is basically what's keeping us alive in the current environment, where some parts of the world are still in lockdown, where people are asked to telework thanks to Zoom platforms, collaboration tools. We can do that thanks to online consumption like food delivery. We can continue our lives without necessarily needing to go out of the door. And there's homeschooling that we can do with thanks to tools coming out of nice companies like Kahoot out of Norway. Yeah, and there's of course a lot of digital entertainment that is available there as well. So technology is quite important in giving a direction to the markets. And we've observed that as well in our portfolio and also in the European market. We've seen that the speed at which European champions are fundraising, and here I've labeled $100 million plus fundraisings. 2019 was already a record year, as you can see, and 2020 year to date has already overtaken the whole of 2019. So fundraising activity for our global winners coming out of Europe is holding strong. And don't be mistaken, there is no error on the slide if a certain logo pops up more than once in a given year. It just means that that company has actually raised more than once in that given year $100 million round or more. So quite interesting statistics. I would not have thought that this would be the case at the beginning of the lockdown end of March. And if we look further at the statistics, and here I'm referring to data from CB Insights and PwC Money, actually Q3 2020 was a global record year for VC funding. In no quarter ever has there globally so much money being raised for funding. In the US, historically, there have been some quarters that topped the 37 billion that you see here, but in in Europe, we had again a record quarter with 9 billion, which is at par with what we've seen in Q2 2019. Q2 2019 was a hot year, a hot a quarter for European venture, and actually Q3 in the midst of still COVID-19 worries were meeting the same thing. The next slide here shows that European tech is really pretty much alive and kicking, as you can see. The market cap of some of our largest tech companies is well ahead of $10 billion. So who would have thought 5 or 10 years ago that Europe would be able one day to showcase this? Well, one could say that potentially GP Bullhound was a bit visionary in this. In 2017, they issued their Titans of Tech report, and they were openly wondering who would be the candidates and whether we would have soon a Titan of Tech in Europe, a Titan of Tech for them being defined as a company that reaches a market cap of or a value of $50 billion. Well, in the midst of the COVID pandemic, 2 of our European companies actually reached that status, Adyen and Spotify. So we have, like I already mentioned, also plenty of other companies that in the meantime managed to reach a market cap of $10 billion. And another interesting data point that I picked up here is that we have for the first time that I know a European company, venture capital backed company that has made it to a listing, JustEatTakeaway.com. We have acquired an American direct rival or competitor for an amazing $7.3 billion. So nowadays, European companies are capable of acquiring American peers for multi-billion-dollar valuations. Again, something that I would not have thought possible 5 or 10 years ago. Moving on, European unicorns continue to be born, and we even have seen in the last couple of months 2 decacorns, private decacorns being born with UiPath and Klarna, both raising rounds at 10 billion plus valuations. So clearly, the tech sector in Europe, the venture capital sector in Europe, is going through the stress test of the pandemic crisis quite well up until now, and that is also translated in our VC performance index a quarter further in time. So at the end of Q2, our VC index bounced back by 6.2%, which means that overall, compared to the end of 2019, we're actually up. And again, also the comparison with our buyout portfolio, we're faring better on the tech side than on the buyout side, and we're also continuing to beat the public markets. And I used the MSCI index for that again here. So how does that translate into real returns? If I look at our portfolio, we see fantastic double-digit returns in our portfolio. What this slide shows is the net IRRs, the top net IRRs of all funds that EIF has invested in between 2007 and 2016. There must be more than 170, somewhere between 170, 200 funds in that portfolio. And the top 80 generate double-digit returns as per the slide. Actually, to be accurate, almost half of my portfolio generates double-digit net IRRs. I just didn't have enough room on the slide anymore to present the top 96, because it's 96 top funds that generate double-digit net IRRs. So and what net IRRs? It's the top 10 is between 40 and 350, 360% net IRR. To give additional data points, actually 3/4 of our portfolio is generating a positive return. So 75% of the funds that we have invested in between 2007 and 2016 generates positive return. This means that anybody that is telling that investing in European venture is a loss-making exercise is getting it blatantly wrong, because I challenge that person. That person is going to find it more difficult to find the 1 out of 4 loss-making funds than the 3 out of 4 profitable funds in our portfolio. How does this translate into, and this is the end of my data session, how does this translate into the benchmarking data? I've used a bit of a complex slide for that here, and I apologize for that, but there's a point to be made here. So these are candle bars with 3 data points per vintage here. So for instance, in 2018, in order to be top quartile, so the 2018 candle bar shows all the funds that were raised in 2018. And the middle point of the candle bar is the median, the -5%. It means that 50% of the funds raised in that year generate more than -5%, and 50% generates less than -5%. The top marker on the candle bar in 2018 at 10% level shows that in 2018, in order to be top quartile, you need to be performing above 10%. And the bottom marker means that if you're performing less, so your net IRR is less than 17% or so, you're in the bottom quartile of the 2018 vintage. Then I've redigested it a bit, and it looks like this. Between 98 and 2002, to be top quartile, it sufficed to have a net IRR between 2 and 6% or so. But then from 2003 onwards, you already needed to have between 5 and 11% to be top quartile. But then comes the interesting part. Since the global financial crisis, since the European venture capital market has matured and the ecosystem has started to perform and deliver, and this flywheel that I presented